Well, I'm joined by Gary Booysen. He's from Rand Swiss. Thank you very much for joining us, as always.
Good to be here.
Good stuff. Now, I mentioned in the introduction about, emerging markets and the high yields that they offer relative to developed markets. We know that there's been a lot of quantitative easing, and that, I suppose, has helped to fuel that demand. But equally, I'm wondering whether, when we look at what's happened in the United States stocks, them reaching all-time highs in recent days, is that partly a factor of all this liquidity that's sloshing around in the markets?
I think it's almost inextricably linked. Last week we did get them hitting record highs again, but again it was on lower volume as well. So volumes on the New York Stock Exchange were probably 30% below average. But it's difficult to separate monetary policy and what's going on in the real fundamentals of companies. So if you look in our local markets, we've been sideways for probably 2-3 years, and we've really seen that earnings have been catching up to the sort of the extended PE ratios on a lot of these stocks. So while the share prices have been going sideways, the companies have been managing to grow earnings, and the market as a result has gotten a fair amount cheaper. So I would say that there is a fundamental argument for owning stocks, but you're 100% right. Whether that fundamental argument is coming from very loose monetary policy, it's difficult to say. So a lot of liquidity, as you say, moving around, a lot of people hunting for yield. So over the last, say, 2 years, we've seen, if you measure the emerging market index versus a developed market index, you've seen that emerging markets have been under pressure. And this year we've finally seen that starting to reverse, and a lot of the big offshore asset managers starting to talk about looking for economies that have growth, because they're sort of realizing that they can't find that kind of growth in the developed markets.
We know that the US is a candidate for growth relative to other nations and all of that, but there is talk in the market that perhaps people are inflating a bubble that's going to burst on the US stock markets.
Yeah, it's interesting. So, I mean, asset price inflation is one of the, I suppose, the results of QE. That's one of the things people have been saying. But again, if you look at the actual, consumer price inflation in the US, it's very, very subdued at the moment, and that's one of the reasons that we don't see. I mean, the entire year we've been saying we think that the Fed rate hiking cycle is going to be a lot flatter than people are estimating. I mean, when we got the first rate hike in December, everyone was saying 4 rate hikes in 2016. We were saying that's absolutely impossible because there just isn't enough, consumer price inflation in that economy. The Fed isn't under enough pressure to actually start a significant rate hiking cycle. Now we've seen that sort of yield curve tapering off dramatically. So at the moment, whether we get one more rate hike from them in December, I think there's about federal funds futures are pricing at about a 42% chance. So definitely a huge reversal on expectations of how fast the monetary authorities are going to tighten policy.
Interestingly, in Japan, I see that obviously they've had a lot of monetary and fiscal stimulus to inject into that economy due to the deflationary nature of that economy. But now it looks as though monetary authorities there are considering perhaps taking, the heel off the wheel in terms of monetary policy, or in terms of quantitative easing, because they don't know whether it's been effective or not.
You see, and I suppose here it feeds into the discussion. You have to separate what's happening in the real economy, so things like GDP growth, the productivity of people on the ground, and what happens in asset prices. So if you see, since they launched, AB's three arrows, stimulus measures and a consolidated fiscal policy reaction as well, you've seen Japanese markets, perform better than they have in decades, and you're really seeing the financial asset prices inflating. But as we see from the latest GDP, I mean, still that not feeding into the real economy underneath. Now you will get some sort of wealth effect as obviously asset prices go up, people feel richer, they'll spend more, and you will get stimulus in the economy that way. But again, these are quantitative easing is a very new and very untested monetary policy tool. So I mean, we've had our first rounds go through the US, and that has been unwound, the UK as well, but definitely it's still a tool that we don't have a lot of data on, and it looks like central banks now leaning more towards, as you say, pushing yields, pushing interest rates negative.
And then let's look at a couple of companies before we run out of time. Construction firm Group 5 reporting headline earnings per share up 64%. Now that sounds very impressive on the surface. Your thoughts on that?
Yeah, so again, that's a little bit of accounting as well. So most of that gain actually comes from the investment in concessions business in Eastern Europe, which it's a fair value adjustment. So inflating those numbers a little bit, it's not completely fake, but if you look at it, their revenue is still down 1%. The engineering and construction in South Africa is still under a lot of pressure. Their order book also down 8% into 2017. So I think this is still a sector that's struggling. There are sort of grassroots, starting to show through, and we are seeing some sort of recovery across the sector. But yeah, Group 5, not a bad set of results, but we also had a trading statement out on the 1st of August. So nothing too much in the way of movement in the share price today, because I think the market pretty much expecting that result.
And then let's move quickly to the gold sector. Anglo Gold Ashanti, we know that the gold price has been firm for a number of months now. It's done very well from the higher gold price, managing to cut its debt by 32%. Done quite nicely.
Yeah, a spectacular set of results. It's actually off slightly on the day, and that's again, we've had a trading statement, and it actually came in slightly behind where we were expecting. So the trading statement, we're expecting headline earnings to be up between 167% and 177%. They've come in at 160% up. Still a fantastic result, so we can't take anything away from the company. Just a little bit of a miss on expectation. So you're seeing the share price come down. Still a little bit of trouble in Ghana with that Booysen mine. A lot of illegal mining going on. But as you say, I mean, this is a company that really has focused on its costs. It's all in sustaining costs now. They produce gold at around $911 per ounce. With the inflation, with the rise that we've seen in the gold price, I mean, that obviously having almost a gearing effect on the company. So I mean, share price performing fantastically well this year, and hopefully if we can get a sustained increase in the gold price, I mean, it'll continue to do well.
Okay, we're going to leave it there. We've run out of time. Thank you so much for your time, as always. Well, that was Gary Booysen. He's from Rand Swiss. After the break, Devon has more business news for you.